It is increasingly clear that the physical impacts of climate change, along with global responses implemented to minimize climate change impacts, could negatively affect financial performance if not carefully managed by companies and their investors. The recently released sixth assessment report from the Intergovernmental Panel on Climate Change has shown that physical impacts are appearing faster and more intensely than expected. Consequently, there has been increased demand from investors for more information to better understand and consider climate-related financial impacts in their investment decisions. The increased disclosure of climate-related financial information will benefit a wide range of stakeholders. It will assist companies, financial institutions, and governments understand their risk exposure and strategically plan for a warming world and the transition to a low-carbon economy. Regulators are increasingly worried about climate-related risk creating systemic risk. Climate-related impacts will influence the value of both companies and assets, and by extension, long-term risk-adjusted returns provided by the capital markets. Climate-related financial disclosure is therefore of critical importance to investors, such as retirement fund and long-term insurers and investment and asset managers investing on behalf of their asset owner clients. Considering climate-related risks and opportunities is part of a governing board's fiduciary duty, and this extends to both boards and directors of companies as well as trustee boards of retirement funds. Banks and insurers are also directly exposed to climate-related impacts via their assets and liabilities by means of the banking and insurance products provided to corporate clients. Increasingly, South African banks have been asked via shareholder resolution at their AGMs to publish policies outlining their climate strategy and exposure to fossil fuel assets. Financial institutions, which collectively provide the market infrastructure for the financial sector, have an interest in maintaining investor confidence and trust and avoiding excessive market volatility. To achieve this, listed entities, for example, must provide sufficient information on expected climate impacts to allow for informed investment and trading decisions by their investors. Civil society can also make use of financial disclosures to hold institutions accountable for their direct and indirect climate impacts. Climate-related financial disclosures can also inform the development of climate change mitigation policies, regulations, and framework by governments. It can also help governments manage the transition to a low-carbon economy and predict the impact of climate-related events on government finances by identifying the value of physical climate risks that may not be covered by insurance within their national borders. For more detail on the issues covered in this video, please see the report outlining the state of climate-related financial disclosure development as part of this South Africa-UK Pact-funded project. We would like to thank South Africa-UK Pact for supporting this educational video. For more information about South Africa-UK Pact, please visit ukpact.co.uk.